Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how are you doing today?
All good in the hood, Joe. Right on, right on. What's going down with you?
Just hanging out in the sun in Tucson. It's 85.
Guns out. One of
Yeah.
those days. Yeah, right on. I hear that. Well, we have some sun. It's a little fake cold sun here going on in Seattle today. But I am sitting here at my quote office, looking out at the Olympic Mountains, and they're nice and sun. Those guns are out too. So. Beautiful day here in the Pacific Northwest.
Can't beat that view for sure.
That's right. I will tell you my drama that I've had the last week, because we like to share that. We like to Joe and I are just talking, guys, and you guys are listening, so you're stuck with us here. But so I know you already know about this, but my drama is that in the last 3 weeks, I have built my dream home, everybody. And today our guest is going to actually teach you how you can get one step closer to that yourself, or about 10 steps closer. But I've built my dream home, and I have a nice, big, beautiful home here out in wherever I live. And about 3 weeks ago, my heat went out. And after a long story short, my Cadillac, super expensive in-floor hydronic heat system boiler took a big poo-poo and basically rotted out from the inside. And I've only been at my house here about 11 years. There's like no way in heck that this big time expensive system should have done that. So long story short, I had to end up cutting into my roof and reventing, shortening the run on my venting because the air intake was wrong and rotted my very, very, very expensive boiler out from the inside. So $15,000 later, I am happy to be mentally sane after 3 weeks of dealing with that. So I'm happy today because I have the heat on. That's all I got going on. What do you got going on? Where are you at?
So Tucson, I don't really need the heat right now because it's 85 degrees outside, and if anything, AC and fans are blowing. But it's a beautiful place down here, and I guess we're a little bit before the snakes and scorpions start coming out. But I hear if you wait longer, they're everywhere. Rattlesnakes, scorpions, all that.
I've been having these me being your mama moments where I'm like, have to change the subject in my mind. Because I keep thinking like, okay, Joe's in Arizona. It's hotter than hell. He's going to go out hiking and he's going to get stuck out in the heat too far out. And he's not used to being in Arizona, and he's going to get dehydrated and something crazy is going to happen. Only reason because that almost happened to me. So I've been having the last few days, as I see you're in Arizona, these mama panic moments, but I know you got it, right?
Yeah, you should just send me a text. And most of the time in Arizona, actually, we've had cell phone service. So I could be like, hey, Julie, I've got, a gallon of water with me. Don't worry. And I can see the van because it's so tall.
Goodness. Well, let me ask you, have you seen any nighthawks out there?
I've been looking, but I haven't seen any yet, but we're going to keep our eyes open.
Well, guess what? I just saw the biggest, baddest nighthawk right on my screen here, in fact, go fly right by my eyes. And that is Mr. Andrew, quote, Drew Kniffin, who's with us today from Nighthawk Equity. Boom. How about that for a transition, guys?
That was sweet.
Nice.
Yeah. Welcome, Drew.
Thanks, Julie. Thanks, Joe. Good to be on board.
Yeah. So for you guys who don't know Drew Kniffin, he is a homegrown, local Seattle boy. We're going to hear his backstory here as we jump into this. But Drew is with Nighthawk Equity. And I'm just going to read just a quick cheat sheet notes off your website. Nighthawk Equity helps you grow your cash flow and build generational wealth through practical education and connecting you with high quality investments. And for you guys might know this name, Andrew's partner is Michael Blanc, who many of you have heard of through his popular podcast, The Apartment Building Investing, or if you've ever been on Bigger Pockets or Flip Nerd, I'm sure many of you know who Michael Blanc is, who is Drew's partner in Nighthawk Equity. Totally rad. Good for you, Drew. We met while we were just talking. We had coffee like 3 years ago when this was probably all brewing for you. And what an awesome story and projection that you've made. Nighthawk, as far as I know, you can correct me if I'm wrong, has over 2,000 performing multifamily investments, valued at over $65 million in multiple markets at this point. And my favorite is that they are ultra conservative when they underwrite their deals. Can't tell you guys how important that is to find a good partner, good syndication partner for those of you who are interested in that. We're going to jump into that today with Drew. And here we go. Sound good, guys?
Sounds great.
Awesome. Well, Joe, kick us off with question numero uno.
Heck yeah. So Drew, the first question always is trying to get to know people a little bit better. So if you could take us back in time, zip back in your time machine there, and take us through kind of like where you grew up, how you got to where you are today, and if there were any influential figures or kind of like things that happened to you along the way.
Yeah, sure. I'll be quick. Grew up in Chicagoland, went to college out there, and then did some graduate school up in Minnesota, Minneapolis, St. Paul, and did a law degree and an MBA. And I was all sort of buckled up to do the corporate route and climb the conventional ladder. That was my vision, my plan. So put myself through a phenomenal amount of graduate school debt, a lot of studying, came out, and I was an investment banker for 2 years. And then I took that skill set into a Fortune 500 company, and I was helping them do financial modeling on when it made sense to partner with other companies, joint venture. And I basically realized that was a lot of work, and I was making other people wealthy with my work. And if I worked tremendously hard, it had a sort of a marginal impact upon my sort of position or salary. And I just didn't love it, to be honest. So that coincided with the Great Recession. And so during that time, my wife and I had bought a condo in Minneapolis, St. Paul, and we wanted to move out of it, but we were underwater. So we rented it, not having any grand plan. And then about a year or two later, I was like, hey, this is pretty cool. Little bit of cash flow. They're paying down the mortgage. The property is reappreciating a little bit, and I'm not really doing anything. And so I thought, well, if I could do not just one of these, but 100 of these, that'd be pretty cool. So that was the aha moment. And then from there, I started doing single family purchases on the side, and we might get into this later, but then I eventually just scale up to do larger and larger properties. And then at the same time, I quit the W-2 job in December of 15. And now I've been doing this full time ever since then. So in a nutshell, that's the story.
Sweetness. Good story. Good rise. Not that long either, too, really, right? I mean, hasn't been that terribly long, which is a good hope for people, and how quickly, if they're focused and they learn the right things and the right steps, that they can get on this awesome path. So do you buy anything locally at this point, or since you're up here with us in the beautiful Seattle area, or are you pretty much all out of state for you guys?
I do have 4 duplexes in Bremerton, so just across the water from us. I will probably be getting rid of those in the next year or so. And then I won't have anything more in Seattle. Seattle is mostly an appreciation market. A lot of people here know this. And that's not the game I'm playing as much. It does work for some people, but we're really more focused on property that go up in value based upon cash flow. So I'm really a cash flow investor, and that pushes me out of Seattle.
Gotcha. Exactly. I think we all feel that pain. How about, do you guys buy anything other? Does Nighthawk buy anything, or Nighthawk with any of their partners buy anything other than multifamily or any other asset classes?
No, we are exclusively focused on multifamily apartment buildings. That's our one focus.
Awesome. How about any local mentors as you were coming up in the game here in Seattle that you can want to give a shout out to, or did you pretty much start reaching out and out of state?
I when I moved here to Seattle in 14, so I'm not original to here. But when I was getting associated here in the market, I did attend Seattle Investors Club a number of times and met a lot of people there that I still am in contact with. And one was Jacob Weaver. Jacob was super helpful in me getting oriented to the Seattle market. So Jacob was awesome. Shout out to Jacob.
Jacob, he's my neighbor, and he's actually my guy. We love Jacob. I knew that you knew Jacob. Hello, brother, Jacob Weaver. But he is an awesome dude. That you guys haven't met Jacob yet. Hang with Seattle Investors Club. Thanks for the unsolicited plug there, by the way.
No problem.
We love Jacob too. So special sauce. We got to get him invested in some of your deals.
Yeah, would love to.
Awesome. Well, here's a question for you. Looking back, there's a lot of debate about, when should you quit your day job? Should you even quit your day job because of that balance of being able to still borrow, somebody needing to have that W-2 to, if you get a bad deal, at least on like people doing BRRRRs and smaller projects. In the multifamily, it's less of a thing maybe, but do you feel that looking back on it, did you quit your day job at the right time, or how did you make that decision, and when do you feel that that's the right time for people to quit their day job?
Yeah, it's a great question, Julie. There's a lot of nuance to the answer. I think at a high level, you have to know that you have, just like we were talking about underwriting deals conservatively, you want to sort of forecast your future conservatively, right? So you want to know that you have a really reliable plan to produce cash flow, to buy groceries, pay for gas, pay for rent, those types of things. So don't sort of exponentially think that you're going to double every single year. For me, you're right. On the multifamily side, having the W-2 income isn't as important because the banks are underwriting the asset itself, not you. So that takes a little bit of pressure off me. But I'd be pretty conservative about that. I would wait until you have plenty of runway and lots of confidence. I wouldn't be too risky about it. Beyond that, you sort of have to get into the nuance of each person's situation. But it
is true when you're in the multifamily, unless you're in a non-recourse loan situation, that if you own more than 20% of the property, you're going to be guaranteeing that loan. Is that correct? That
is true. Yeah, we focus on non-recourse loans, so it doesn't end up being a huge deal for us. But you're right. The banks will definitely. Initially,
though, when you kick off, do you have like a period of recourse sometimes during your stabilization period, or no?
Not on the properties that we're purchasing. In fact, let me think. We have one deal out of our 10 where there was recourse on it, and that was sort of a we won't do that again kind of moment when we took that one on.
Awesome.
So our deals are out of the gate non-recourse, which is fantastic from a sleeping well at night standpoint. Excellent.
Well, let's get back to what Nighthawk Equity is all about. We have learn plus invest equals freedom, which is that's about as simple and straightforward as it gets. Totally rad. You have a partner on the learn side, on the invest side. You run the show on that. Tell us about, how that works with yourself and Michael on your partnership on Nighthawk.
So Nighthawk Equity is an investment vehicle where we buy multifamily properties. And what's neat about it is we'll partner with people who bring us great deals, right? So essentially anyone can bring a deal to us, we'll underwrite it, and if we think it makes sense, we'll say, hey, we'll partner up with you. Let's say, Julie, you bring a deal to us. We'll say, let's partner up, Julie. And so we'll create a new company. It'll be Nighthawk Equity plus Julie. And together we'll own this apartment building, say in Phoenix or say in Tucson, right? And we will underwrite it together. We'll raise money for it together. We'll close on it together. And we'll manage the property to our pro forma over the course of the 5 or 7 years that we hold it. So it's a great vehicle. It allows people to get in the game on multifamily, and it allows investors to passively invest, get into an alternative asset class that has great performance characteristics, great recession resistance characteristics, great tax benefits, and allows them to diversify away from the stock market. So a lot of people win from doing what we do at Nighthawk Equity.
Right. I think one of the things on your Nighthawk website, it says, why multifamily? Well, one reason it states, right on the front page of your website is that multifamily loan delinquency rate was 90% lower than the residential rate during the last big recession.
Yeah.
It's just, like you said, that multifamily offers low risk and above average returns. I mean,
yeah. When I talk to friends and family that are less educated, their mindset when I talk about real estate is, oh my gosh, all the houses that went into foreclosure in 2008, 2009, 2010. Drew, you're a gambler. That's the mindset that people have. And so it's like, no, let's peel back the onion a little bit. First of all, there's a unusual story to that time, but how single family homes performed in the recession is totally different than how apartment buildings performed, right? So apartment buildings, essentially no one foreclosed on those. Those continue to perform because they're full. They're full of people who have nowhere else to go. Apartment buildings, there's no technology that's going to displace apartment buildings as the fundamental place where most Americans live. And as long as you buy it right, and you market it right, it's going to be full, it's going to cash flow, and you're going to be able to have a lot of confidence about appreciating that property and increasing its value over time.
Where do you think that if people fail on apartments, and maybe it happens once in a while, where do you think the failure happens?
I'll give you two areas that it happens. It happens because your underwriting is too optimistic. Michael and I call it putting on your happy years. So you're like, oh, rents are, we all know this in Seattle. For a while in Seattle, rents were going up 5%, 6% a year. Those are huge numbers, right? And then what you've seen the last year in Seattle is 0% rent increases or bigger concessions from the owners, 2 months free or first month half off, right? So you've had huge expansion and then you've had a little bit of flattening. So if you put your happy years on, you think, I'm going to have 5% rent growth for 10 years. And if you take that number, you put it in your financial model, anything looks great. So I think people can underwrite with their happy years on and not be mindful of the fact that recessions happen, all that kind of stuff. So that's number one. And number two is getting bad property managers. I mean, you're going to buy something that's, millions of dollars. And then you're literally turning over the keys to someone that you've basically never met. And you're going to say, manage this thing. And I have had experiences where bad PMs took a property with phenomenal potential and they basically ran it into the ground. And so got to keep your eyes on them. You got to find the right ones. And if you find the wrong ones, you got to figure out how to put the right person in there. So those are the two ways that things go wrong most often that I see.
And I'm assuming you guys hire third-party property management companies because of your busy and location. That's not your focus, right?
That's right. That's not our focus. I mean, some people do try to self-manage. I would say there's usually excellent third-party managers who know that geography, who have systems in place, and frankly, don't have that high of fees. When you have single-family property managers, their fees are about triple what a multifamily property manager's fees are. So it just makes sense. It's not worth my time to recreate what they're doing. I'd rather look for the next deal.
Exactly. Let me ask you, so when people are sending you guys deals, obviously you don't want just random people sending you deals. I'm sure you'd like to see as many deals as you could possibly see, but what's the process you would like people to follow who want to start sending you deals? What kind of, they should engage with you, obviously, right?
Yep.
They should engage through Nighthawk and get involved with you on your coaching programs and everything else. But what kind of information, do you want them, you don't want people to just send you an address and a rent roll, right?
No, it's got to be thorough, right? So we have essentially a very sophisticated Excel document called the Syndicated Deal Analyzer. And it's the prism through which we look at all our deals. So it's not expensive to purchase. It's about $100. And it's phenomenal. In fact, it's how I first became friends with Michael's, because I was an investment banker. I did this all day long, but I didn't want to recreate the wheel. And it was just a really good tool for doing this type of work. So all our deals, if they come to us and someone's pitching the deal, they need to be analyzed through the Syndicated Deal Analyzer. And then they need to meet some certain criteria. It needs to be conservatively underwritten. And our general guideline is we want to say to investors, passive investors, we're going to double your money in 5 to 7 years, and we're going to have an average of 8% cash-on-cash return. So that's the framework that we want to get deals in. It needs to come in through the SDA, it needs to be underwritten well, and then we'll review it together.
Excellent. Awesome. How about deal size, number of units?
Yeah, we're 80 units and up right now is the size that we're looking at. So we actually have another platform where we'll look at smaller deals, but for it to go into the Nighthawk shoot, it's got to be 80 plus and probably $2 million of debt or more.
Okay. And Let me ask you. So 80 units plus. You guys aren't doing any ground up stuff. Are you interested in any multifamily stuff like that?
We're not doing ground up. It's just a lot more risk in that, and it's not our forte. So, we all face the challenge of shiny object syndrome, which is, I want to do storage lockers, I want to do mobile homes, I want to do flips, I want to do whatever it is. And one of the things that you can get attracted to is ground up, but it's just not our focus. It's not our forte. We want to know what our sandbox is and stay inside that. So that's Class B, Class C, cash flowing multifamily. That's what we're about.
Take a C minus, polish it to a B plus.
It's usually that's the right. I mean, so in order to syndicate a deal well, and we're in year 7 of a bull market, so asset prices have gone up, cap rates have gone down. So in order to find a deal that makes sense, you have to basically, I say you have to have a problem to solve. There has to be something wrong with the property that you're going to make right. You're going to make tenants' lives better, and in doing so, you're going to get better rents, right? And so, what you just said, Julie, you're going to take a C plus property and make it a B minus property. You're going to find a property with vacancy distress or physical distress, and you're going to fix that problem. That's how you make your money. That's how you improve the community that you're purchasing.
Let me ask you, that's a little quick, easy analysis. Are you guys, and maybe it's not answerable or it's not the right question or something, but are you guys into finding like we said, like a C plus and clicking it up to a B, or a B minus, like that type of spread? Or are you looking for C minus trying to get to B plus? Do you get what I'm saying? Well, that means like the bigger value add. So are you looking for a complete shit ball that might not cash flow well in the beginning, or do you need cash flow from day one? That means, so here's how I analyze it. If you want cash flow from day one and then you want to improve upon it, your spread from the C minus to the B plus can be the hairier and the worse cash flow from the start is there. You start saying, we want to be a little more conservative. Maybe you're talking like we said, like C to B minus is a good enough bump.
Yeah, I think this is what I'd say. You can over improve a property, right? You can. There's tons of times where you can put in finishes that you'd put in on your own house, but tenants aren't going to pay you more for that. And so you have to be mindful of what works in this geography. So that's what I'd say is number one. Number two, you have to be mindful of what financing strategy you have. So there's basically two. I'm going to buy this property with fixed agency debt and hold it for 10 years, right? Or I'm going to buy this with a bridge loan with rehab dollars, and then I'm going to refinance into longer term debt. So that second strategy gives you more money to do more repairs on the property, but it also increases the risk, right? Because that's a bridge loan. It's going to last 24 months. The interest rate might move around, and then you don't know what the credit market's going to be like in 2 years. So without getting too technical, those are some things that are going to influence your decision about how much to move it up. But in general, don't over repair a property. Know how much improvements that market will support.
Right. And so which one do you prefer? Do you have a preference, or is it just deal by deal on which one of those is the Nighthawk preferred deal?
I think that we prefer to make a medium or moderate rehabs as opposed to like a full rehab.
Okay.
So we're not going to go from C to A, for instance.
Gotcha. And so what does a typical project look like for you guys? You're going in and and maybe it's too general of a question, but are you going in and you're having to put in new cabinets, or you're keeping existing cabinets, you're putting in some countertops, new flooring, paint? Yeah. Do you add like a washer and dryer stack? I mean, my background, I'm grew up in the multifamily world doing exactly what you're doing for a big private local investment company here.
Yep.
And traveled all over the U.S. doing that sort of thing as the senior asset manager. So I've lived in that world for 16 years is my previous world. So, are you guys going in and adding washer dryer stacks, or taking laundry rooms and getting rid of those and adding a bedroom and putting washer dryers in the units? Are you going that deep, or are you more one click back from that typically?
Yeah, that would be a pretty big rehab for us, right? So we've done, I was down in Texas on Monday and Tuesday, walking a property that we have under contract right now. And we walked every single unit, about 500 units. And the question was, do the units Do they need to have new cabinetry, or can we just resurface the fronts and put on some hardware? Do they have vinyl plank flooring throughout? So, flooring issues. We have not yet done a deal where we've put in washer and dryers, but that is a significant value add. It's also very expensive to do that from an electrical and plumbing standpoint. But I would say it's one click back from that to answer your question at a high level. Usually we're putting about $5,000 to $7,000 in per unit on the inside, and then maybe another $2,000 on the outside. Maybe we're fixing up amenities, pools, security gates, siding, roofing. So a big renovation.
When you say that, I go, oh my God, that's like, it cost me $5,000 to step outside my front door here in Seattle. Just even the locations, getting out of town, the labor costs, and it's crazy.
Well, you're right. Seattle numbers are crazy, right? Like we said a bit ago that I have some duplexes in Bremerton, and the prices that I was being quoted for painting the duplex were the same prices that I pay for turning an entire unit in other geographies. So that's just labor prices and the cost of doing business in Seattle versus other places. So that's one reason why we're not in Seattle, is because it's just so expensive to do work here.
Yeah, I can't figure out why what they're buying here. I mean, the only thing I can think of is it's foreign money or an exchange money. It's like an exchange play that you got to park it or do something. I don't know. Okay, well, let's dive into that a little bit more in regards to you guys. What I love about what appears you guys are about, and I look forward to becoming one of your investor partners, is that you're conservative. Mm-hmm. I can't tell you guys how, there's a lot of fluff out there with everybody's a coach. Everybody's got a website, and somebody's good at tech. Their website looks great. The videos, photos, puffing, bragging, all that shit is all a bunch of fluff and BS. Conservative underwriting. If you are looking to invest with some syndicator and they haven't used the word conservative in the very first conversation you've ever had with them, then turn around and go the other way.
Yep.
That's my tip for you guys. So you guys at Nighthawk are ultra conservative. Let's talk about what the definition, for example, of conservative is. For example, it might be, like you say, when you underwrite, and that means do deal analysis, that you include the replacement reserves above the line, right, in your deals. Explain to the average Joe what that means.
Yeah, and I'll give you an example of it too, right? So every property, every apartment building is going to wear down over time. You're going to need to buy new cabinetry or new flooring or wash or replace the carpet, that kind of stuff. And you're going to want to sock away money for that just every month, right? You just have a rainy day fund. Right. So the question is, when you're accounting for that deal or you're projecting it, does that money that you put aside for stuff that happens, do you count that against your cash flow or not? So we call that above the line or below the line. And we put that above the line, right? So depending upon how old a property is, we might put in $350 per unit per year or $250 per unit per year against our financials, which negatively impacts our cash flow. And so when we project to investors, here's what we think our cash on cash returns are going to be. Here's what our overall returns are going to be. We're letting those numbers negatively impact our returns. There are other groups that put that below the line. And the impact upon that, Julie, we're actually doing an analysis on that exact question for this Texas deal I'm talking about, was changing the IRR, the internal rate of return, by about 5% from 16 up to 21. Well, that is a huge difference. And there's other people out there that are going to solicit or sell their deals as a 21% return.
Yes,
and we're that same deal, if we underwrite it differently, but that one distinction, we're gonna say 16%. But the reality is, Julie, over the course of that deal, you are gonna replace carpets, you are gonna put in new flooring, you are gonna repaint. So those eventually will be real costs, and so they should be above the line. You should be underwriting that conservatively, and so we do. And then just one more conservative underwriting thing. We never forecast selling the property at the same cap rate that we're buying it at today. So that's a little bit technical, but we basically are always assuming that the market is going to get softer when we sell it compared to when we buy it. And so we'd love to be wrong and for the market to stay strong, but chances are it won't. And so we want to be prepared for that. We want to build that in. So if the market stresses us, we can still have confidence that we'll hit our projections.
And one other thing I see that you guys do is that you build in like beneficial loan extensions if you're using a bridge loan, even though I know you don't like to do, that's not your deal of, your number one choice to do that. But just thinking, these are things that experienced people think about, guys, experienced people. So rewind and listen to what we just said about, almost like a threshold test of anybody you're talking to. If they don't use the word conservative, or you ask them point blank, what are the conservative underwriting measures that you use on your deals? And if they stumble, then turn your back and go the other way.
We have another deal we're working on right now, Julie, where we are marketing as a 5-year hold on a bridge. We actually, and the bridge product that we are purchasing is 5 years of bridge money. But we plan to cycle out of that deal in 18 months. But if things go wrong, we have another 3.5 years to work on that loan. So, there are people who had good performing properties with bridge loans when the last recession happened, and then banks just tightened up and they wouldn't loan. And they also couldn't find a buyer, and they had to foreclose and give the property back to the bank, even though it's performing, simply because they didn't have extensions in their bridges in those loans. So it's a good product. It can work well, but there are some risks associated with it, and you want to be careful.
Hey guys, Joe here. I just want to take this super quick break from the action to let you know something that we have really cool to offer you guys. As you know, marketing is the lifeblood of our real estate business, and Julie and I spend a ton of money sending out postcards and letters to people all around the Seattle area. We've partnered up with YellowLetters.com to get you guys 10% off all of your marketing needs at Yellow Letters. All you have to do is go to YellowLetters.com, and when you check out, use the code Seattle Investors Club, and you'll get 10% off any of your marketing needs at YellowLetters.com. You can send postcards, letters, whatever it may be that YellowLetters.com has, so that you can keep your marketing engine running for a little less money. So go to YellowLetters.com, use the code Seattle Investors Club with no spaces, and get your marketing going today. All right, let's get back to the action.
You know what the crazy stuff is Drew, is that this type of stuff, if you know what you're doing, isn't like extreme brain surgery. It's just conservative. If you understand, right? It's almost like everybody should be thinking that way. Why doesn't, there's something missing, I think, if people don't think that way. You guys are, I love it. I'm totally, like, my heart is beating fast. I'm excited right now.
Two things. We get deal fever. We just want to get a deal done. And so we do whatever we need to do to get the deal done. And we think that the future is going to be as good as it has been the last couple of years. And then the second thing is that, like, a lot of us in this industry, people on this podcast, we haven't been through a recession or multiple recessions. We came into this industry since the last recession. And so we haven't kind of had, we haven't had those war wounds. And so if we have gone through that, we know that things don't always work out well, and we end up underwriting more conservatively.
What are the banks requiring on replacement reserves these days? Are they at 250 or what are they at?
250 to 350 is what I've been seeing in the last couple of deals. 250 is actually looking a little bit light nowadays. So I see closer to 350, but it does matter the vintage of the product, right? So if you buy a property, we bought a property, 168 units, and the prior owner had renovated every single unit, and then we just bought it. Basically, they flipped it to us. So everything was new. So the replacement reserves on that property are lower because it just got new appliances. But if you buy a property that's kind of been neglected and you're the person that's going to be doing the facelift, well, you're going to put in a lot more money.
Right. What are the banks? What's debt service coverage these days?
1.25. 1.25 is basically minimum. If you're doing a bridge product, then they're more flexible, but they charge you more money for it. But they want to see 1.25.
Awesome. That's been. Do you ever seen it lower than that? I mean, shouldn't be. You should underwrite to it anyway, right?
We always underwrite to that, and I haven't really seen it lower. We have some good lenders that we work with, and we just stick with them. Yep.
How about cost segregation? Is that part of your business model?
Absolutely. I mean, the cost segs are just amazing. So just to catch everyone up, cost segs, you buy a property, the IRS says that property is going to last for 27 years. The building part of it is going to last for 27 years. But there's stuff inside the building. There's the carpets, there's the refrigerators, there's the light fixtures, and those have different lives. They have shorter lives. Refrigerators don't last 27 years. Carpets don't last 27 years. So we account for those things differently. And with the cost seg, you can basically have an accounting engineer go into your building and segment up how much of the building are stuff that depreciate on 5 years, on 7 years, on 15 years. And with that, you get more depreciation on your property. So we have a property that kicked out $80,000 of cash last year. It was a great property. But the K1s, the tax forms that investors are receiving right now in tax season, show that the property had an accounting loss on it. So even though we're giving our investors cash every quarter, an 8% cash on cash return, they're going to take their tax forms and count it against their regular income, and they're going to have less taxes owed to the government because of the cost seg. It's an amazingly powerful tool. It's one of the great reasons to invest in multifamily. And I'm just amazed at how powerful that is, Julie.
Who do you guys use for that? Use the same group over and over, or do you guys? How do you do?
It's called ETS, Engineered Tax Services. They've been really good to us. I think they did 6 cost segs for us last year.
Maybe we'll get them on the podcast. How about that, Joe?
Yeah. Sounds good.
We'll give Drew. We'll give you a shout out to them as a big good topic to cover.
Yeah.
How do you guys underwrite your rents, projections, one, how do you do it? And what do the banks allow for rent rolling? I guess I'll call it, is an old school term.
Yep. No, that works. So a couple things, right? So first of all, what's the current rent roll, right? And so if your current rent roll in the trailing 12 months actual before we buy it, and then you show me your year one forecast and there's a 20% increase, I'm probably going to call BS unless you can really substantiate it. So that's one thing, is just the T12, trailing 12 versus year one. I want to see that. Second thing I want to see is, I don't just want your projections, Julie or Joe. I want property managers who manage properties just like that in that geography give to you their pro forma. Here's what I want the property manager to say to you, here's what we can do, and here's what you can hold me accountable to do for you in year one.
You want their buy-in.
I want their buy-in because guess what? The listing agent just wants to sell the property. They don't have to live with their pro formas, but the property manager does. But then not only that, I want 2 PMs to say that, right? So, and I don't want you to say to PM, hey, PM, property manager, we think we can increase rents by 20%. Do you think it's possible? And they sort of back into those numbers. I want you to give them a blank piece of paper and just say, hey, tell me what you think we can do on a revenue basis and on an expense basis. And they fill it out and give you that information back to you. And then I want 2 different PMs.
That they undersell themselves on that so they can outperform a little bit. That's human nature.
It's a balance, right? Because if they're too low, then I'm tempted to not go with them, but to go with the other person who's promised me more.
Right.
But yeah, I have a PM who manages most of our properties at Nighthawk, and they do a pretty darn good job of delivering to their forecast. And the other thing that good PMs will do is they'll manage to their budget. So, like if they say that the expenses are going to be about 50% of revenues, but they're 60%, I can say, hey, why are we high last month? What can we do to trim that in? And we'll work toward it, right? So they don't just spend money whenever there's a supposed need, but they're really going to try to maintain the budget. So, those are important things to be working with on your property manager.
Exactly. Do you, I used to have this, I called it a cash flow forecast, where I'd take the budget for the year, and then I'd take the actual, and every month, I'm talking to the managers weekly, or in my case, it was, let's say, monthly, and I'd reproject the year. It was such an awesome tool. I called it my Bible. I was able actually to predict the cash flow almost to the T by the end of the year, like months and months and months ahead of time, right? Such a powerful tool when it comes to that sort of stuff.
We're looking at budget to actuals every month, just like you're saying, Julie. And
what I did is I inserted my checkbook balances, beginning and ending, into that equation. So it would adjust and forecast my checkbook balance as part of that. I'd love to buy you a beer sometime and show you that sort of geeky stuff.
We won't geek out too much, but we, every quarter we're distributing to our investors. So every quarter we have to actually send out X amount of dollars. And so every month I'm saying, are we on track to hit that? Are we or are we not? What can we do? What do we have to do to maintain that? And so it's always first and foremost in my mind is that.
Awesome. Good stuff. So how hard is it for you guys? It seems easier for you guys, the way that you're set up with your coaching and the students, to find deals. Are you finding more deals through students or through your broker relationships?
Mostly through our students, mostly through people who bring deals into the deal desk, but there are outside brokers who we have relationships with that'll send us off-market deals, pocket listing deals, and we'll evaluate those too.
When the students bring you a deal, are they coming with a broker entail, or is it purely off-market?
So some of our students come from a wholesaling background or a flipping background, and they have the skill sets, they have the background, they have the processes to sort of get in front of the brokers and truly get to the off-market deals.
Awesome.
So for those ones, I'm like, yeah, go do it. Get a campaign out there and try to get directly to owners. I will say that the typical owner of a 50-unit apartment building is a different breed of person than the owner of a dilapidated single-family home, right? They're probably more sophisticated. They probably are more patient. So you have a lower yield or a lower success rate. But that's really powerful if you can get upstream like that. For most of our students, they do build relationships with brokers in their chosen geography and find deals that way.
Do you find that most of the sellers of your deals own it in some sort of entity or LLC, or is their name on title?
No, it's through an LLC. Yeah, it's through an LLC.
Okay, cool. Let's see, what else do I have? You guys, as far as, how are your returns structured on the deals that you offer? You guys get a deal and you offer up 50%, of the deal for 100% of the equity, or what's the splits there on how much you offer up?
Right. Every deal is unique, so we underwrite each one differently. So it'll be something like an 80-20 split or a 70-30 split, right? So for, let's say it's a $10 million purchase and we're raising $3 million for it. The investors are going to bring in $3 million, and in exchange for that $3 million, they're going to own 75% of the ownership of the deal, something like that. 70 to 80% is usually how it works. Gotcha.
Now, how about, do you and Michael have skin in the game at all, other than do you have any cash invested into these deals?
Yeah, we do. Not on every deal, but I would say on most deals we do. Some deals, what we'll do is another part of the structure is an acquisition fee. So again, let's say it's a $10 million purchase and there's a 2% acquisition fee. So I'm just doing quick math. I think that's $200,000. Instead of taking that money and putting it in my pocket at closing, I will put it into the deal. Number one, because it's skin in the game, and it says to the investors that I believe in this asset. But number two, it's taxed much better. So one thing we haven't nerded out on together is the huge tax benefits of multifamily versus single families and versus flipping. But so that acquisition fee, sometimes I'll put back into the deal, both to show skin in the game as well as because of the tax benefits of it.
Awesome. I looked, because I joined, of course, Nighthawk myself recently here. I'm super stoked about it. Will you guys have some stuff in there? You label your deals inside your dashboard there as Class A. I don't think that means Class A, looking at the deal. What does that mean? And just curious.
I see. I think what you're referring to is, so when we structure a deal from a legal perspective, it's an LLC. And the ownership in LLC there's A units, think of it like shares of stock, but A units and B units. And so when it says Class A, they're saying we're selling or we're soliciting A units in this deal, something like that.
Gotcha. Okay. Is there any preference given to, I imagine at this point, you guys can raise your money pretty damn fast, right? Is there any preference given to investors in deals? Let's say you need to raise only $1 million and somebody says, what, do you have a cap on how much somebody can invest on the high side? Like if I said, I want to put $300,000 in, you going to let me do that? Or is there a cap?
So the bank may underwrite you personally, right? If you own too much of the deal, they're going to be like, well, we want Julie Clark to be signing on this deal. So you might not want to do it. We do invest that put in, I think, $600K on one deal, but that was a larger deal. And the raise there was 4. And so I don't know if it met a certain threshold.
I think it's a 20% threshold. Is that
the threshold? Right. The threshold is usually 20%. We don't usually have that, a cap to how much you can put in. We haven't faced that either, I would say, Julie. We have a minimum, right? So usually we're not, depending on the deal, we're not going to allow anyone to invest less than 50,000 or less than 100,000.
Okay.
But we don't usually have a cap. If someone wanted to put in $1 million, we'd probably have a special conversation about that. It's a good problem to have, right?
But so let's say you probably have, like I said, I'm sure you have a great list of investors at this point. Do anybody get preference? Like if you're in other deals, you get first shot or first come, first serve? How's it work?
No, we don't have preference. We try to be pretty democratic, right? So we have our webinar. Here's the deal. Here's the metrics of it. Here's the risks, and here's the opportunities. Here's our forecasts, and then we'll answer any questions you have. And then it's sort of a first come, first serve into escrow. Otherwise, we could be accused of favoring Julie over Joe. And we don't want to be like that. So it's just here's the escrow account. Ask any questions. So when you feel safe, you feel comfortable, wire your money in. And the first, once we meet our cap, then we close the fund, and we'll see what the next deal if you didn't make this one.
And it's on the investor, the user, to they don't have to say, Drew, you don't have to say, okay, Julie, you're in. It's like just I wire my money, I'm in. As long as we have a relationship and we've got that whole legal stuff.
So one important thing without getting into the legal stuff is not anyone can invest. You don't have to be an accredited investor. You can be an unaccredited investor. Most of our investors are unaccredited, but we can't just take anyone off the street. We have to have a relationship with them and understand that what we're doing is a match for how they want to invest. So once we make sure that's a match, then legally we can allow unaccredited investors to invest. So that is an important step.
Do you guys have any deals available right now you're raising for?
We do. Yeah, we have actually a really good deal. It's in Memphis, Tennessee, where we have many of our deals, and I'm putting money in it myself. In fact, I just wired some money for a good faith deposit in yesterday on that deal. So yeah, it's a great deal. We'll have a webinar pretty soon about it. If you or listeners want to get on our website and sign up, then you'll get emails announcing the date of the webinar, and we can share with you all the details about the property.
And tell us where people can go if they want to engage in your platform and all that. And
it's
coaching, investing, and all that.
It's nighthawkequity.com, and that's our website. And then from there, you can click join, and that'll give you the opportunity to sign in, and then you'll be included in all our email blasts about investment opportunities.
Let me back it up here. I'm going to back up the bus for a second. What is the challenge and hardest part about all this for you?
Good question. Building systems to accommodate the growth of the business and make sure that we don't get carried away with growth for growth's sake, but doing everything well. So, just growing in a smart way is the biggest challenge from an organizational perspective. And then that goes for investing too. It's different when you're underwriting one deal a month versus one deal a week. You got to get smarter about it and make sure that you don't get sloppy in your underwriting or just assume that things are good on due diligence. But you really have a system to move everything through in a logical, sequential way that you're confident you looked at everything.
How many people on your team? Or is it just you and Michael?
There are 4 now.
Okay.
No, I take it back 5. There's 5.
Well, I asked you what the hardest part is. What are you most excited about for the future?
Well, I think we have a lot of deals that have phenomenal potential, and a lot of them are starting to turn the corner. We're starting to deliver on our plan. So the numbers are turning around, as well as the quality of life for our tenants is turning around. So I'm excited about delivering on our promises. 2 tenants, 2 investors, to our students, and improving on all those different metrics. So
awesome stuff. So tell us, how did you, just back it up, how did you actually come about meeting Michael Blanc and partnering up? That's you guys have a stellar partnership. Again, I think lots of you listening know who that Michael is, and now even as importantly, you know who Drew is. And he's one of our local guys here. How lucky we are to have that. Maybe we're going to be able to twist his arm and have him do one of our quarterly meetups or some sort of special event for Seattle Investors Club members. Totally stoked. I have some other ideas, Drew, with Jacob maybe to talk about offline here. But yeah, how did you meet Michael? And then we'll wrap it up. And I'm going to ask you one more thing after that, and then we'll let you go off and make your piles of money.
Yeah, but I did what we all encourage each other to do. I was just networking, and so I bought Michael's syndicated deal analyzer, and I was like, man, this thing's really good, and I used it to evaluate and purchase a 32 unit. And I wrote him an email just saying, hey, I used this product; it was really good. And I thought he'd never respond back to it, and he wrote back, he's like, really? That's awesome. Tell me more. And so we just went back and forth, and we just hit it off, really from day one. And then a little bit later, about a year later, he came back and he said, my coaching program is growing, and we need more coaches to help people do this industry. And one of our criteria for coaches is they've been able to quit their job because of multifamily investing. And that was true for me. So I became coach number one, essentially. And then the relationship just blossomed. So it was just like networking and just talking to people and just sharing successes. And it went from there. It was very organic.
Awesome. We love organic. What is Dealmaker Live? And tell us what's up with that, and how are you participating, or what?
Yeah. So Dealmaker Live is our big convention. We do it twice a year. This year it's going to be down in Dallas, July 25, 26, and 27. We'll have phenomenal speakers down there where you're talking about how people do deals, how they grow their businesses, how they underwrite. It's a phenomenal place for networking as well as education. And there'll be, I'm trying to remember the numbers for this one, but I think there's going to be 600 to 800 people expected to be there. So great event. I'll be speaking. And so that's our next big event is the Dealmaker Live down in Dallas.
Awesome stuff. I know a lot of you guys listening like to scoot around to the different badass conferences. Shout out, while we're talking about conferences, to our friends Tarl and Grace, Tarl Yarber, who's getting ready here at the end of next month to host the Pacific Northwest Big Badass Real Estate Expo. Hey, Tarl, I just said that like mouth, I didn't even stutter, so I finally got it down. If you guys are in the Pacific Northwest, or even if you're not, you're listening from wherever you're at, this is the event to be at in the Pacific Northwest. You can find more information. Just Google Pacific Northwest Big Badass Expo, which is spectacular. Do you know Tarl at all?
I do know him. Yep. Yeah, we've emailed back and forth a number of times.
Sweet. Yeah. So, but of course, if you're focused on multifamily and that sort of thing, and you guys want to get involved in the world of Drew Kniffin and Michael Blanc, definitely head down to Dallas for Dealmaker Live. Is that that's the first one this year, did you say? Or
we had one back in January, but this is our big summer event. Yep.
Okay, there's a big summer event. Awesome sauce. Okay, very last question. Any books, any podcasts or books that you like that we can share with our listeners so they can get further educated?
Yeah, I mean, we all say Rich Dad, Poor Dad. And that book is good because a lot of the books are like mechanics, like how do you do this? How do you do due diligence? That book is like is mindset shaping. So I love that one because it reframes your mind from having a paycheck every 2 weeks to creating your own life, that kind of thing. So I liked that one very much. And then I also loved The Millionaire Real Estate Investor by Gary Keller. As an oldie but a goodie, and it was a little bit more tactical, and that one just kind of laid out the vision for how you could, I told you I went from one condo to, and then my vision was 100. Well, that book was the book that made me realize people do this, right? And so I love those two books. Those really shaped me and sort of set me on the course to this, and made me realize that, yeah, I'm not crazy. This is achievable. So those two influenced me a lot.
Awesome. Any great podcasts that you listen to for fun? I know you have kids, 4 kids, like under 6. So maybe you're listening to like Disney or Looney Tunes or something like that.
No, I don't need podcasts to get more of that. The Michael Blanc podcast, right? The Apartment Building Investing podcast is just huge because it's focused on apartment buildings. That's all we talk about in the podcast. So that one's been fantastic just for, hearing from the smartest minds in the industry about how they underwrite deals, how they do asset management, how they grow a business, how they how do banks underwrite deals, all that sort of stuff. So, all those podcasts I listen to pretty regularly.
Awesome sauce. Well, Drew, so great to have you. Thanks for spending your time with us today. Again, let's tell everybody, if you want to engage with Drew further and get involved in their coaching and their platform and the ability to start sending deals. One last question. Where do you buy deals? You guys look in Midwest? I mean, anywhere. Somebody could spin you a deal from Spokane if it made sense, right?
Yeah, I would say, in general, we're geographically agnostic. As a practical matter, our purchases have been in the Southeast. So Memphis, Chattanooga, Huntsville, Alabama. We're looking in Texas right now. So kind of the Southeast, sort of the region where there's, we want to see demographic and job growth in that geography. So we got a deal once from West Virginia and everything kind of looked good, but we were like, man, this place is cratering. So it's got to be a place that has like a good story behind it, because that's important to sell to investors. So I would say, generally speaking, in the South, in the Southeast, where people are moving to.
Awesome. Well, good stuff. I'm going to wrap it up then. Thank you again so much. Can't wait to get more involved with your guys myself. For all of you that would like to continue to learn from Seattle Investors Club and all the kick-ass, very smart guests and people in our network, and you want to engage further with me and Joe as helping you lead the charge there, one way to do that would be if you're around here, every Tuesday from 12 p.m. to 2 p.m., we have a investor, broker, just general, you don't have to be a broker, wholesaler, anybody, birds, whatever you do, come join and hang out with us from 12 p.m. to 2 p.m. in Burien at the Elliott Bay Brewhouse and Pub for just a small group coaching mastermind. It's different every week. It's a great small crowd where you're going to get intimately getting to ask all your questions, the nuggets that flow through this little meetup and mastermind. It's totally different than the 100-person meetup that you're going to in town. I guarantee you the value is through the roof. Come see me, Burien, Elliott Bay Brewhouse and Pub, 12 p.m. to 2 p.m. every Tuesday. If you want to learn how to jump more into my world and be on the forefront of who's doing what and people that I can refer you to, like Drew, to help shortcut your path to success. I look forward to meeting you. See you there. It's free. Other than that, Joe, how do they get the details about this awesome podcast today? Where can they find it?
Yeah, if you guys are driving and you want to get to the show notes or the links that we talked about today, head over to seattleinvestorsclub.com/70. That's seattleinvestorsclub.com/70. And remember that this show is free to subscribe to on iTunes or your favorite podcast listening source, and that we also love the reviews. So keep sending those reviews. We love to have them.
Awesome sauce. I'm going to do one last little plug here. If any of you guys are out there that are interested in, getting a real estate license and being both an investor and a broker at the same time and seamlessly being able to wear those hats and switch around those hats, that's my expertise and I'm your gal. And I want to talk to you about that further. So hit me up at julie@seattleinvestorsclub.com. But better yet, just come see me on one of those Tuesday small group masterminds. And that's all I got. All right, right on. I'm looking at a picture of Joe's big, giant muscles here. So time to quit and go do something else right now. Right on. Thanks, everybody.
Cool. We'll talk to you guys
so much.
later.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.